Hello, everyone. Welcome to Talk Talk Speak podcast today. We're doing something a bit different. Welcome to the deep dive. Think of this as your shortcut, your express lane to understanding really crucial ideas from the financial world. We dig through the sources, pull out the key knowledge so you get the insights fast.
Saves you the time.
Exactly. And today we're tackling the Kostolany egg theory.
Right, developed by André Kostolany, sometimes called the German Warren Buffett. It's a really interesting way to look at market cycles. It focuses less on just numbers and more on, investor psychology and where the money's flowing.
Yeah, he sounds like he was more of an observer of people, not just charts.
Absolutely. A keen observer. He wasn't your typical quantitative analyst. He valued experience, gut feeling almost, based on watching the market's mood.
And his ideas are still around in books like A Speculator Confesses Originally Ein Spekulant Gesteht.
That's the one, a classic.
So this Kostolany egg, it's a visual metaphor, right? Like an egg shape showing the market cycle.
Precisely. It maps the ups and downs. And the key drivers are funds. That's the money supply, the liquidity and psychology, which is basically investor sentiment, the collective mood.
Sounds simple, but I bet there's depth there.
Oh, absolutely. It looks simple, but it's quite insightful. Kostolany himself would say it's not a crystal ball, mind you. He always stressed the importance of experience.
Right, you can't just apply it like a formula.
No, but it's a fantastic framework for thinking. So our mission today is to really unpack this theory, look at its interpretations, how you might, apply its principles, and whether it still holds water in today's very different markets.
Okay, good plan. So maybe start with the man himself. Who was André Kostolany?
Good idea. His life story is, pretty fascinating and definitely shaped his views. Born in Budapest in 1906, studied philosophy, art history initially.
Oh, interesting. Not finance straight away.
No, his father nudged him towards finance in Paris. And he got hooked on the European stock markets pretty quickly.
And he had quite a career arc, didn't he? Some major ups and downs.
Definitely. He actually profited from the 1929 crash by short selling. Imagine that for a start.
Wow. Talk about learning under pressure.
Right. He navigated tricky situations like the Austric affair, made money from Germany's post-war reconstruction, even speculated on old Russian Tsarist bonds.
He wasn't afraid of risk then?
Not at all. And he was open about it. Admitted he went bankrupt twice.
Really?
Yeah.
That's refreshing honesty.
It is. He had this belief that a speculator doesn't need to be right all the time, just, slightly more than half the time. That really tells you something about his philosophy.
Yeah, it suggests it's not about perfection, but playing the odds smartly over time.
Exactly. And these experiences led him to challenge the whole efficient market hypothesis, the idea that markets are always rational and prices reflect all information.
He saw the irrationality firsthand.
He did. He focused on psychological factors, how hesitant investors often mess up, and how stubborn investors can capitalize on that.
Okay, let's break down some of these core Kostolany ideas. First up, speculation. He saw it differently from just gambling, right?
Absolutely. For him, speculation wasn't just rolling the dice. It was a thoughtful activity. It involved anticipating broad trends, economic, political, social.
So more strategic.
Yes, he made a clear distinction. Speculators are the strategists, the visionaries. Then you have players who are more like market gamblers, and then investors, the traditional long-term holders.
Got it. And then his famous equation, funds plus psychology trend. This seems central.
It's the heart of the egg theory, really. He argued market trends are driven by two things: the amount of available capital, the liquidity that's funds, and the overall mood or sentiment of investors. That's psychology.
And you need both pulling in the same direction for a strong trend.
For a sustained upward trend, yes, both need to be positive. If one or both are negative, the trend falters or reverses.
And he was famously contrarian, the whole buy on bad news, sell on good news thing.
Yes, buy when the cannons are roaring, sell when the violins are playing. That's the quote. It captures his contrarian spirit perfectly.
Love that imagery. He also said something like, what everyone knows doesn't interest me.
What everyone on the stock exchange knows doesn't excite me. Exactly. He looked for the information or the angle others were missing.
Okay, now the man and dog analogy. How does that fit in?
Ah, yes. It's a great way to understand market volatility versus the underlying economy. Imagine a man walking his dog on a leash.
Okay.
The man represents the economy moving forward at a relatively steady pace. The dog is the stock market running ahead, lagging behind, darting side to side.
Right, much more erratic.
Exactly. But ultimately, the dog is attached to the man by the leash. So while the market the dog, can have wild short-term swings driven by emotion and news. In the long run, it has to follow the general direction of the economy, the man.
So it explains why the market can seem disconnected from reality sometimes, but fundamentals matter eventually.
Precisely. It cautions against getting too caught up in the short-term noise.
And this ties into his distinction between stubborn and hesitant investors.
Absolutely fundamental. The stubborn investors, he sometimes called them strong hands, are the ones who are knowledgeable, patient, and crucially, well-funded enough to withstand volatility. They tend to win.
And the hesitant, the weak hands?
They're the opposite. They're easily swayed by emotion, by the news, by the crowd. They tend to buy high when everyone's excited and sell low when everyone's panicking.
And market bottoms often happen when the shares move from the hesitant to the stubborn.
That's a key insight. When the panic selling is absorbed by those patient, stubborn buyers, it's often a sign the worst is over.
So it really comes back to independent thinking, patience, and learning from experience, not just following the herd.
That's Kostolany in a nutshell. Experience was paramount for him in judging market phases. You couldn't just learn it from a book.
Okay, solid foundation on Kostolany's thinking. Now, let's crack open the egg itself. You said there are two main interpretations.
Yeah, it's not just one single diagram. There's sort of two lenses. The first, often shown with phases A1 through B3, looks more at the internal dynamics of the stock market sentiment, volume, the flow of stocks between those stubborn and hesitant types.
Okay, focus on the market itself.
Right. The second version, usually phases A through F, is broader. It uses interest rates as the main driver to think about asset allocation, when to be in stocks, bonds, real estate, cash, based on the bigger economic cycle.
So one's more tactical for the stock market, the other more strategic for overall assets.
That's a good way to put it. A1, B3 for market sentiment timing. AF for the big picture asset shifts driven by interest rates.
Let's tackle the A1 to B3 model for sentiment and volume. You said it's like an egg shape, phases up and down.
Exactly. 3 phases going up, correction or initial rise,
Yeah.
adaptation or sustained rise, and then overheating. And 3 corresponding phases coming down. It tracks the psychological ebb and flow.
Right, there's usually a table outlining this. Let's start with the upswing. A1, rising initial. What's happening here?
So this is the market starting to climb, often after a sharp fall. The key signal Kostolany looked for was low trading volume.
Low volume. Why is that important?
Because it suggests the buying isn't frantic speculation. It's the stubborn investors carefully stepping in, seeing value. Sentiment is still pretty cautious. And crucially, bad news doesn't really tank prices anymore.
The market's absorbed the negativity.
Exactly. Kostolany's advice here, buy.
Makes sense. The contrarian move. Then A2, sustained rise. What changes?
The trend becomes more established. Volume starts picking up as more people notice the hesitant investors start dipping their toes in. Sentiment gets warmer. Good news generally pushes prices up. Bad news might cause dips, but the overall direction is still positive.
And the strategy here?
Hold. But stay watchful. Don't get complacent.
Okay. Then the big one. A3, accelerated overheating. Sounds like the danger zone.
It is. This is where prices shoot up rapidly, often on very high volume. Everyone's talking about the market. Your taxi driver's giving you stock tips.
Aha, the classic sign.
Exactly. Greed is high. FOMO, fear of missing out, is rampant. The hesitant investors are now piling in. And here's a key tell. Even good news might struggle to push prices much higher. The market's just saturated with buyers. And bad news, often completely ignored.
What's Kostolany say to do here?
Sell. Get out while the getting's good.
Okay, that's the climb. Now the fall. B1, initial fall. What's the shift?
The peak is past. Prices start heading down. The big shift is sentiment optimism turns to worry, maybe even denial. Volume might shrink initially as early sellers cash out. Now, bad news really hurts, and good news doesn't seem to help much.
Kaji.
Sell, or at least move to cash if you have it already.
Then B2, sustained fall. What's the mood?
Fear starts to dominate. Pessimism spreads, especially among those hesitant investors who bought late and are now underwater. Volume can be mixed, sometimes bursts of panic selling, sometimes low volume because buyers are just gone.
Grim. And finally, B3, accelerated bottoming. This is where the stubborn investors step back in.
Precisely. This is maximum pessimism capitulation. Often see very high volume as the last hesitant sellers throw in the towel in panic. They sell to the stubborn investors who are now seeing deep value. Sentiment is terrible. But here's the counterintuitive signal again. Bad news stops driving prices down further. The selling pressure is exhausted.
And the advice?
Buy. This is the time the contrarian gets interested again.
You mentioned number of stockholders being an indicator in the original theory. How relevant is that today with index funds, ETFs, algorithms?
That's a really important question. Yeah, just counting individual shareholders might be less useful now, but the principle behind it, tracking the flow of ownership, is still critical. Are shares moving from weak, emotional hands to strong, patient hands?
So we look at different data like institutional flows, short interest.
Exactly. Sentiment surveys, put-call ratios, institutional positioning data, these can be modern proxies. But those core psychological signals, bad news doesn't push prices down at the bottom. Good news doesn't push prices up at the top. Those remain incredibly powerful, regardless of who's doing the trading. They reflect the underlying psychology.
Okay, that A1B3 model gives a great feel for the market's internal mood swings. Now, the other model, A through F, based on interest rates and asset allocation, this is the broader view.
Yeah, this one steps back and looks at the whole financial landscape, using interest rate movements as the main guide for where capital should ideally flow.
Let's walk through it. Phase A, interest rates peaking. What's the move?
When rates are at their highest, cash is king, basically. Money flows into savings accounts, deposits, money markets because they offer attractive, safe returns. Capital leaves riskier assets.
Makes sense. Phase B, interest rates start to fall. What happens next?
As deposit rates drop, bonds start looking better, their yields are fixed, and as rates fall, existing bond prices tend to rise. So money moves from cash into bonds.
Okay, phase C, interest rates fall rapidly. The next shift.
Now, borrowing becomes much cheaper. If the economy is slowed, real estate might look attractive, prices might be down, rental yields decent, plus bond investors might take profits. So capital starts flowing towards real estate.
Driving property prices up eventually.
Right, which leads to phase D, interest rates at lowest point.
Seems like a good time for growth assets.
Generally, yes. Money is cheap, liquidity is abundant. This tends to support prices across the board, stocks, commodities, maybe even keeping real estate elevated for a while. It's often a period of economic recovery or expansion.
Then phase E, real estate prices peak. Where does capital look now?
After a good run in property, smart money might start thinking it's peaked. They sell, take profits, and often look towards the stock market, especially if the economy is doing well. So you see a flow from real estate to equities.
And finally, phase F, economy overheats, interest rates rise. Back to caution.
Exactly. Inflation picks up, central banks start tightening, raising rates to cool things down. Stock markets might have had a strong run, maybe look frothy. Investors get nervous about rising rates hitting growth and profits, so capital starts moving out of stocks and back towards safety cash, maybe short-term bonds again. The cycle begins anew.
It's interesting, as you said, the sources don't explicitly draw lines connecting, say, phase A3 in the first model with phase E or F in the second.
They seem presented as complementary frameworks. You use the AF cycle for your big strategic asset allocation decisions over the long term, driven by interest rates and the economy. And you use the A1B3 cycle for more tactical timing within the stock market, paying close attention to sentiment and volume.
But we can see logical links, right? Like the stock market boom phases, A1 to A3, probably happened during the lower interest rate expansionary parts of the AF cycle.
Generally, yes. You'd expect the stock market's A phases to broadly align with, say, phase D, lowest rates, phase E, money flowing into stocks, and maybe the early stages of phase F, economy heating up but rates not yet biting hard.
And the B phases, the downturn, would align with rising rates or economic slowdown.
Likely, yes. B1, B3 might correspond to late phase F, rates rising, economy slowing, phase A, peak rates, risk aversion, and phase B, rates falling but maybe economy still weak, bonds preferred.
And the man and dog analogy fits well here too, doesn't it? The A1B3 sentiment cycle is the dog's short-term zigzags.
While the AF interest rate cycle reflects the long-term path of the owner, the economy, it highlights how sentiment can detach short-term, but the economic reality eventually pulls the market along.
And that funds element from the core equation that's directly tied to the interest rate cycle, isn't it?
Absolutely. Phase A in the AF model with high rates means funds are scarce or expensive for the stock market. Hard for stocks to rise even with optimism. Conversely, phase D, lowest rates, means funds are abundant and cheap, which can fuel stock market gains.
It shows how central bank policy directly impacts that funds part of Kostolany's equation.
Definitely. And large institutional investors making big bets based on macroeconomic forecasts that also directly moves the funds, affecting currencies, asset prices, linking everything together.
Okay, let's really nail down that core formula. Funds plus psychology, trend. We've touched on it, but let's refine the definitions. Funds is overall market liquidity.
Yes, the availability and cost of capital. Not just individual savings, but bank lending, central bank actions, international flows. Scarcity hinders markets. Abundance fuels them, sometimes even if the underlying economy isn't great.
And psychology is that collective mood.
Exactly. Fear, greed, optimism, pessimism, the sum total of how investors are feeling. And this is where the stubborn versus hesitant dynamic plays out.
And you need both to be positive for a sustained rally.
That was his strong belief. Both negatives means a downturn. Mixed signals often mean a sideways, choppy market. And they influence each other. Lots of cheap money, funds, can breed optimism, psychology, creating bubbles. A sudden panic, psychology, can cause money to flee, funds, leading to crashes.
Let's talk more about those stubborn versus hesitant investors. The stubborn ones, what are their key traits again?
They have what Kostolany called the 3 Gs. Geld, money, Gedanken, thoughts, ideas, and Geduld, patience. They have capital, they think independently, and they can wait. They buy low in panic, B3, and sell high in euphoria, A3. They're the minority, maybe 10%.
And the hesitant, the other 90%.
They lack those Gs, especially independent thought and patience. They follow the herd, react emotionally to news, buy high A3, sell low B3. They are the crowd.
And the transfer of shares between them is the key signal.
It's a huge signal for Kostolany. When shares move from hesitant to stubborn hands, that's often near the bottom, B3. When stubborn hands start selling to the excited, hesitant crowd, that's often near the top, A3. It explains why most people tend to underperform. Being contrarian is hard.
It takes discipline, which links back to his emphasis on contrarianism and experience.
Exactly. The egg is fundamentally a contrarian framework, and you can't apply it mechanically. He always said judging the tops and bottoms takes experience, experience, experience.
Which makes it tough to, say, backtest with a computer.
Very tough.
Yeah.
It's more art than science, guided by principles. That's a limitation if you want hard, fast rules.
Yeah.
But it reflects the reality of markets, perhaps.
So, for practical application today, how do we use this? What signals should we watch applying his ideas?
It's about observation and combining signals with that sense of experience. Key things Kostolany highlighted.
Like the reaction to news.
Definitely, that's a big one. Near the bottom, B3A1, you see bad news hitting the headlines, but the market doesn't really fall much further. Bad news isn't pushing prices down. That suggests the selling is exhausted, stubborn hands are holding.
And the opposite at the top?
Right. Near the top, A3B1, you get great earnings reports, positive economic data, but the market just yawns or even drifts lower. Good news isn't pushing prices up. That signals the market is saturated, hesitant hands are fully invested, and the smart money might be leaving.
What about trading volume? How does that fit in?
Volume patterns are crucial context.
Okay, so early rise, A1.
Low volume with rising prices is actually good. It means the rally isn't driven by mass hysteria.
A3, overheating.
Very high volume as prices peak. That's a warning sign. Lots of shares changing hands, often from stubborn to hesitant investors, fueled by hype.
And on a way down, B1, the initial fall.
Often, volume might decrease initially or stay low as prices fall. That's worrying, shows a lack of buying interest.
And B3, the bottoming phase.
This is where you often see a spike in volume, high volume after a long fall. That's the capitulation, the panic selling from hesitant hands being absorbed by stubborn buyers. It can signal the turn is near.
And watching investor sentiment itself, media tone, public interest.
Yes. Are magazine covers screaming, buy stocks now? It's probably near A3. Is the news full of doom and gloom, saying stocks are dead? Maybe closer to B3? Observing whether the crowd, hesitant, or the contrarians, stubborn, seem to be driving the action.
So it's about putting these pieces together, news reaction, volume, sentiment, and trying to gauge the phase.
Exactly. And remembering, it's all relative. High volume means high relative to recent history. The impact of bad news depends on the prevailing mood. It requires developing that feel, that experience Kostolany talked about.
Has anyone tried to apply this systematically?
Well, the source mentioned a financial writer, Anna King, analyzed Taiwan's market in the S&P 500 using the egg theory. His book apparently focuses on identifying opportunities in different phases, blending it with other analyses, but stresses patience and discipline.
But precise timing is still the challenge.
Always. Kostolany himself said, if it were easy, everyone would be rich. The egg is a thinking tool, a guide, not a magic formula. The diagram helps, but applying it is an art.
Could these principles apply beyond stocks and bonds, like, say, crypto?
Theoretically, yes. The core idea of cycles driven by available funds and mass psychology, that feels universal. Fear and greed operate in crypto too, but The specific indicators, the speed of the cycles, the nature of the funds that would likely be very different and need careful adaptation.
So, thinking about today's markets, what's the lasting value of the Kostolany egg? What holds up and what are the big challenges?
Well, the biggest strength is its timeless insight into market psychology.
Hmm.
Fear, greed, herd behavior, those haven't changed. Humans are still humans.
That part feels enduring.
Definitely. Also, its cyclical view is crucial. It reminds us markets aren't linear, booms follow busts, and vice versa. That helps counter our tendency to just extrapolate the current trend forever. It's a good framework for strategic thinking, avoiding short-term noise.
But the market structure has changed dramatically since this time. High-frequency trading, algorithms.
Huge challenge. Do algorithms amplify the psychological swings, making the dog run even wilder? Or do they dampen them? It's debated. They certainly change the speed and maybe the texture of the phases.
And quantitative easing. Massive central bank intervention.
That directly impacts the fund side of the equation in ways Kostolany likely never imagined. Post-2009, some argue QE distorted cycles, making funds overwhelmingly important, maybe lengthening the A phases or softening the B phases. It adds complexity, but maybe doesn't invalidate the core idea, just changes how it manifests.
What about passive investing? Index funds, ETFs dominate flows now.
Another big one. Does the rise of passive investing make the number of stockholders indicator even less relevant? Does it just amplify herd behavior as money automatically flows into indexes? Or, as one source suggested, does it actually create more inefficiencies in individual stocks for stubborn, active investors to exploit?
Interesting point. If everyone's buying the index, maybe individual stock picking based on contrarian ideas becomes more valuable.
Potentially. Then you have globalization capital zips around the world instantly. And the speed of information now. Sentiment can shift incredibly fast.
So applying it requires navigating all this modern complexity.
Yes. And the core criticism remains. Judging the phases accurately in real time is incredibly difficult. It relies heavily on that subjective experience.
So it's more a qualitative guide, a way of thinking, than a precise quantitative tool.
I think that's the fairest assessment. But its value as a framework for behavioral finance, even though it predates the formal field, is significant. It captures so many core ideas about biases and irrationality.
Okay, to wrap up, what's the key takeaway? The core value of the Kostolany egg theory for someone listening today?
I'd say it's a really powerful way to conceptualize market cycles. To understand they're driven not just by numbers, but deeply by human emotion, the interplay of liquidity, the funds, and sentiment, the psychology. It highlights predictable patterns that emerge from collective behavior.
But crucially, it's not a magic system for guaranteed profits. It's a guide for strategic thinking, right?
Exactly. It's about developing market intuition, thinking independently, and having the courage to act against the crowd when your analysis and experience tell you to.
So maybe the ultimate value isn't perfectly timing every A1 or B3 phase.
Perhaps not. Maybe it's more about cultivating that stubborn investor mindset Kostolany championed. Understanding these cycles, understanding the psychology, can help you stay rational when everyone else, the hesitant majority, is losing their head.
It helps you keep perspective during euphoria or despair.
Precisely. It encourages patience, discipline, and a healthy skepticism. Kostolany's legacy, I think, reminds us that to succeed long-term in markets, you need to understand the data, the algorithms, sure, but you also need to understand the stories, the narratives, and human nature itself. That makes his insights relevant, even as the market machinery evolves.
A great final thought. It's about understanding both the man and the dog, perhaps. Thank you for joining us. See you next time.